So slippage, as I know, is in very basic description is I'm a trader and I have well, does it apply to opening a new position? Well, okay.
You see the price and you open a position.
You see the price. I send a position. The requested price, I, as a trader from my trading terminal, requested a specific price, an X price. And what I get
You're placing
back,
a market order, right?
I'm placing a market order. It's sent to the market through the technologies that we're talking about, MetaTrader or whatever trading platform, to your Bourse, which is the bridge, and et cetera, right? So the price that comes back is not the same as what you requested. And slippage could be to your favor and also against.
Correct.
And it all depends on demand, supply, the quotes that are happening in the real market.
Correct.
So expand on that point.
Sure. So when it goes through the bridge or gateway, so MetaTrader 4 is the bridge and MT5 is the gateway, or fixed API session, doesn't matter. Then it arrives to a trade execution engine. And it can be anything, right? Majority of technology providers in our field are aggregators. So they aggregate different liquidity feeds, or doesn't matter, different liquidity providers, and that's the price they stream into their platforms, and that's the price they execute against. Now, they can then send it to the liquidity provider, and that's the real market's conditions, right? They send it to the liquidity provider, and it can be, as you said, in your favor or against you, because the market, the price has moved, right? We have a matching engine, so we have a central order book, so it gives you a bit more technical capabilities. But for asymmetric slippage, what that means, and in general, what best execution means, is that if there is a slippage in the favor of the client, you have to pass that on to the client.
100%.
Now, there are a lot of technology providers who do not only allow asymmetric slippage, meaning that if the slippage is in favor of the client, they still give the client the price they requested. But there are also technology providers who artificially add that slippage on top.
Against the favor.
Precisely.
Which is so bad.
Precisely. Right? So, and you know, the thing is it easy to do? Yes, it is. Like technologically, it's very simple. It's not. But do you really want to use that? Or do you, okay, you can have a B-book and fair enough, you're market making. But then at least have the decency of, I don't know, having several layers of liquidity the way it is in the real market, and do price it accordingly. Say, okay, there will be, it's a market depth, right? So the markup will be higher if you execute more volume, you know? It's possible, but make sure that you actually adhere to the standard of the industry. And I think we really, really don't need to do that if we want to continue all working in that industry.
Yes. Now,
regarding coming back to the toxic flow, very often in this industry, what brokers see as toxic flow is a profit-making flow, which is not toxic. Profit-making flow is fine as long as you price them correctly. And that's where the whole mechanics of the industry breaks. When instead of pricing them correctly, they try to pass them on to the liquidity providers, meanwhile offering them the same conditions they would offer to the standard retail flow. Now, from the banking point of view, at least when we all had a PB, when we were working with banks, what toxic flow is when the dealers had, for example, would want to abuse the latency or would have some inside knowledge, or, for example, because of course the market has a depth, right? And the banks are streaming certain layers of volume. And they have different algorithms. They have price regeneration algorithms. There are a lot of different things they do based not just on speculation, the way our industry is based, but based on their internal needs. And so they will be posting the bands of volume. Like, I want to buy Euro USD at this price. I need 100 million, for example. And they want it filled. And what they see as the toxic flow is that in the same microsecond not millisecond, microsecond. They get hit on that band from, let's say, 10 different venues. So they wanted to sell 100 million, but instead they sold what? Billion, right? So that's what they saw as the toxic flow. Someone who's trying to, well, I can't say front run, but is trying to get more volume at a cheaper price.
Got it.
And that was what's considered a toxic flow in a real institutional industry, not someone who's making money.
Right.
And that's where I see the problem is that we have changed or broken down the mechanics of the whole financial market so much that we have brokers who say we're market makers and that's how we can offer you better conditions, trading conditions. Fair enough. But when you go against the rules of nature, where you offer zero spread and you offer swap free and you offer this and you offer that, and you do not adhere to the rules of the market, or you do not vet through your flow, okay, fair enough. You have a profitable trader. He's really good at trading. I'll put him in the other group. Charge him a little bit of spread. So there's at least you can have that spread. You can capture that value in the spread, instead of actually abusing him, artificially changing his, yeah. So, and that's what we stand for. We help brokers be profitable and successful and offering those conditions to the clients without having to really be rogue and change those conditions and go against the clients.
Thank you for watching. If you liked that video and you want to watch the full episode, it's available here. Remember to like, subscribe and share. It helps the channel.